Hi everyone, my name is Fred ICAN, your P4 lecturer. We're going to pick it from where we stopped last session. In the last session, we looked at Miller and Modigliani traditional theories and the theoretical background and the formulas that we need to calculate cost of equity, market value, and then the WACC. Okay, so we're going to apply those formulas straightforward in Berland and Canalot. Okay, so I'm just going to read it straightforward and then we start solving them. Okay, there are two questions in here, so I want us to handle them one after the other. I'm just reading Berland and we solve it, and when we finish, we come to Canalot and we solve it. So I start. Berland PLC has annual earnings before interest and tax of 15 million. These earnings are expected to remain constant. The market price of the company's ordinary shares is 86 pence per share, cum Dave, and of debentures 105.5 per debenture ex interest. An interim dividend of 6 pence per share has been declared. Corporate tax is at the rate of 35% and all available earnings are distributed as dividend. Berland long-term capital structure is shown below. Ordinary shares reserved 16% debentures. Required. Calculate the cost of capital of Berland PLC according to the traditional theory of capital structure. Assume that it is now 31st December 2004. So I have to calculate the WACC on the basis of the traditional theory. First point of attention for this question is that traditional theory and cost of capital is the same as the normal way we calculate our WACC. Calculate your cost of equity using your dividend valuation, calculate your cost of debt, calculate market value of equity, market value of debt, and then weigh them together. So don't let that traditional theory of capital structure change anything. It's the normal way we calculate our WACC. So if I have to calculate WACC, I need cost of equity. I need market value of what? Equity. I need cost of debt. I need market value of debt. How do I calculate the cost of equity? I'm going to use the dividend valuation in this case. To calculate using the dividend valuation, you ask yourself, is dividend constant or dividend growing? Okay, now, if you come to this question is telling you, and all available earnings are distributed as dividend. So your dividend is your earnings. However, that dividend valuation formula, as we know to be, our cost of equity is equal to dividend divided by the market price multiplied by 100, didn't come by itself. It came out of the P0 D divided by the cost of equity to get the market price. And the market price formula is saying the market price of the share is the present value of the future dividend. Okay, so this is another trick in this particular question. We want the future dividend. We don't want the current dividend, or we don't want the past dividend. But what we have been doing over and over in the past, they give us the current dividend and we assume that it is going to be the same in the future. So when they separate the future dividend from the current or the past dividend, you would have to know which one you should use. You would have to use the future dividend here because it is out of this formula that they got the cost of equity formula. So if you come to this question, they're telling you that the earnings will be the same as dividend for the foreseeable future. It's going to stay constant. But currently, interim dividend of 6 pence has been paid. Okay? So therefore, or has been declared. So therefore, you are not going to conclude that that 6 pence is your dividend now. I mean, your dividend you need for the formula. That 6 pence is the dividend now, but we don't need the dividend now. We need the future dividend for that particular formula. So we wouldn't need this dividend as the D. we will need the future dividend, which they said is equals to what? The earnings. What is earnings? Earnings is profit after tax. Question told us there is 15 million profit before what? Interest and tax. The company is having debt. So once they having debt, we would have to less interest out of that 15,000 to get a profit before tax, apply the tax on it, and then we get a profit after tax. So this is what we try doing it here for you. This is what we try doing it here for you. So to get my future dividend, question assume that is going to be the same as the earnings, because all the earnings will be paid out as dividend. So earnings before interest and tax given to me is the 15,000. Earnings before interest and tax is the 15,000. What is the interest? According to the question, debt value in the balance sheet given is 23,697. Interest on that debt is 16%. 16% of that should give you the 3,792. And then deduct, you get the profit before tax. Apply the tax rate of 35% to get your tax. If you take the tax out of it, you have got your earnings, and the question says your earnings is the same as what? Your dividend. So this is my dividend. The formula I am trying to substitute figures in is this one. I have got my future dividend. I am not interested in the current dividend. I need the future. So if you go to the room, they give you current dividend and they give you the future dividend. Is the future dividend you need for the cost of equity. Next, I've got one bit of the formula. I also need the market value. The market value should be equals to the ex-div market value. And we said the ex-div market value is the cum div minus the current dividend. So this is the separation. But most of the cases, your current dividend is the base for the future dividend. When they separate them for you just here, separate them. So your ex-div market value is the cum div market value minus the current what? Dividend, because that market price should be the present value of the future dividend and it should exclude the current dividend. So it should be you comparing like against like. You have to be comparing like against like. Okay, you should be comparing like against like. So that is that. So let's go straight to the question, and then we will pick the information in there. Okay, what market price was given to us? Question said that the market price of the company's ordinary shares is 86 pence per share cum div. So if it's cum div and I need ex div, I would have to take off what? The div. Which dividend do I need? I need the current dividend, and they said it's 6 pence. So I have to take the 6 pence out of the 86 pence to get the ex div, and I'll multiply by number of shares. And remember, number of shares will be 125 divided by the 25 pence par value. So that is what we did it down there for you. Okay, that is what we did it down there for you. 1 minute, please. Okay. So you will see that the number of shares we said is the 12.5 divided by or multiplied by 0.25, which is like 4, isn't it? So we get 50 million, and then the ex div, we take the cum div, we deduct the 6, you get a 50p. My concern is how you be able to distinguish between the future dividend and then the current dividend for the purpose of the ex div. And when you multiply the 80p by the 50, you get a market value, and then you know the cost of equity, because the dividend is going to stay constant, should be that constant future dividend divided by the market value of equity, and then you get what? 18.21%. This is the only thing that we would wanted to bring your mind on, how you be able to distinguish future and then the current what? Dividend. The cost of debt, because the debt is redeemable, we all know that we would have to calculate the internal rate of return. Is the same old story. So market value of the debt, we got 105, interest net of tax, and then the redemption value. Okay, and then we assumed 8% and 9%. You calculated the MPV of each of them, and then you put in the formula, you got the cost of the debt. This level, at this point, everybody should be very comfortable with this. And market value of the debt, you take the total book value, multiply by market price, divided by the 100. Don't forget about 100. And that should give us what? The market value. And what will be your WACC? Your WACC should be the weighted average of the cost of equity. So equity, market value of equity, cost of debt, market value of debt. And then sum of the two will give you the 65, and this is the normal WACC. So when you get a question, say using the traditional theory, you are using your normal calculations. And then also remember, when you are using the dividend valuation, you should be able to distinguish between the future dividend, that is what you need as the D, and then the current dividend, that is what you need to use to calculate the ex-div. But if you are lucky enough, you go there and the examiner gives the current dividend as the base for the future dividend, just as we've been doing. You just pick it and then you carry on with it. Okay, now let's move on to Canalot. The modern form of calculating the WACC is the Miller and Modigliani approach. And as we just saw in the previous session, we concluded that Miller and Modigliani and the traditional theory, all of them are giving you the same word, conclusions eventually. So whether you use the traditional or use the Miller and Modigliani, you would have to come back to the same answer. The good news is that Miller and Modigliani is faster and easier to manipulate than the traditional one, even though that one is easier to understand. But of course, it is really, really time consuming. So let's take this one as an example. Canalot PLC is an all equity company with equilibrium market value of 32.5 million and a cost of capital of 18% per year. The company proposes to repurchase 5 million of equity and to replace it with 13% irredeemable loan stock. Canalot earnings before interest and tax are expected to be constant for the foreseeable future. Corporate tax is at the rate of 35%. All profit are paid out as dividend. Using the assumptions of Modigliani and Miller, explain and demonstrate how this change in capital structure will affect the market value, the cost of equity, the cost of capital of Canalot PLC. Explain any weaknesses of both the traditional and Modigliani and Miller theories, and discuss how useful they might be in the determination of the capital structure of a company. Okay, now I would have to emphasize that if you get this sentence up here, then you are very lucky. Most of the P4 questions, nobody is going to tell you using Miller and Modigliani principle. But my worry, as I keep telling you, is how you will see Miller and Modigliani. How you will see Miller and Modigliani. You will see Miller and Modigliani when you are moving between geared and ungeared companies, okay? It could be two companies involved. It could be only one company. It could be two companies whereby A is geared and then B is ungeared. It could be the same company, it was geared, it is moving to ungeared, or it is ungeared, it is moving toward geared. All of them, Miller and Modigliani, will be flashing you. So here, Canalot is all equity, okay? And Canalot is thinking of bringing in debt. So currently, Canalot is all equity. When they bring in the debt, they will have debt and then what? Equity. Okay, so it's the same company moving from ungeared position to geared position. As long as we are moving between geared or ungeared and geared, and we need market value, we need cost of equity, we need cost of capital, which is the WACC, Miller and Modigliani is calling you because this is preposition 1, preposition 2, and then preposition 3. So this is how you would have to see Miller and Modigliani in the questions. So what would we do? If I want market value, Miller and Modigliani told us that in the world of tax, the market value of a geared company should be equal to the market value of ungeared plus the present value of the tax savings. So I will say for the market value, I will say the value of the geared should be equal to the value of the ungeared plus the DT. The value of the geared should be equals to value of the ungeared plus the DT. So therefore, what is the value of the ungeared? If you go to the question, it's the same company. Canalot is ungeared first. When it was ungeared, what was its market value? Its market value is 32.5. So the ungeared value is simply 32.5. So I put a 32.5 here. So this is 32.5. What then will be the DT? The debt value is 5 million and the tax rate is it 35%? So 35%, and that is giving 1.75. So this is 32.5. Therefore, what will be our total value? Our market value overall is supposed to be 34.25 million. 34.25 million. Okay, 34.25 million. So that is basically that is the A. So if you are able to see Miller and Modigliani, obviously our life is easy. Now the I want you to use cost of equity. If you look at what we did in the note, we used the traditional approach, which was used for illustrative purposes. You can have a look at that one, but we are interested in Miller and Modigliani. Once I need cost of equity, I am going to have Miller and Modigliani preposition 2 flashing me. And preposition 2 is saying cost of equity geared is equals to cost of equity ungeared plus the risk premium, which is calculated as cost of equity ungeared minus the cost of the debt 1 minus T divided by equity. Okay, so now I am trying to pick a situation from an ungeared position to Canalot of what? A geared position. Currently, Canalot being ungeared, its cost of capital is 18%. Cost of capital is WACC, remember. However, we all learned that where the company is ungeared, its cost of capital, which is the WACC, is the same as its cost of equity. Therefore, if Canalot WACC ungeared is 18%, then its cost of equity ungeared is also what? 18%. The debt they want to raise is bringing in a cost of what? 13%. Therefore, we can put them in the formulas and then we will be able to calculate that. So when Canalot goes to geared, its cost of equity should increase by the risk premium as a result of bringing in that debt. Okay, so we say the cost of equity here ungeared is 18%. 18% minus the cost of debt of 13%. Its debt that we are bringing is its debt is 5 million multiplied by the tax rate. Tax rate is 35%, so we're going to have 0.65 divided by, now be with me. Okay, this is the VG. And we all said VG is the corporate value. VG is the corporate value. And corporate value is value of debt and value of equity. So when they become geared with a market value of debt of 5 million, then equity figure is supposed to be less. And that equity figure should be equal to the difference of 29.25. So 29.25 is what you would have to bring in here. The 29.25 is what you would have to bring there. So watch out, okay? When we bring in debt and we become geared, then we would have to think of the corporate value being the value of debt and value of equity. So when you solve this, your cost of equity geared is supposed to be about 18.56%. So the 0.56 is the premium to compensate for the 5 million debt financial raise that you brought. And this is your cost of equity. So the issue here is not the formula. The issue here is Miller and Modigliani make life easy. Only problem is how you'll be able to know that it is Miller and Modigliani. Preposition 3 deals with the WACC. So WACC, okay? And according to Miller and Modigliani, the WACC of the geared should be equals to the WACC of the ungeared multiplied by 1 minus dt E plus D. You playing with formulas. Okay, so what will be the WACC of Canalot when they move from the ungeared position to the geared? Currently, their WACC is 18%. 1 is 1. What is the DT? We calculated the DT up there, if you remember, and that DT is the 1.75. 1.75. So you have 1.75 divided by equity, we said is 29 point, we just got them here, 29.25, and that is 5. You can put the total market value there anyway, 29.25, and then plus 5. And then when you solve this mathematically, you should be able to get 17.08%. Okay, 17.08%. So this is how we will calculate using Miller and Modigliani's. Obviously, the assumptions or the limitations of Miller and Modigliani's are the assumptions of bankruptcy costs and all those problems that we know. Okay, so you can have a look at them. That's exactly what we talked about, the limitations of Miller and Modigliani. Okay, so now let's move on to chapter number 6, which deals with capital asset pricing model. Capital asset pricing model, which deals with capital asset pricing model. Okay, with a capital asset pricing model, according to the capital asset pricing model, the cost of capital should reflect both business and financial risk. Should reflect both business and financial risk. 1 minute. Should reflect both business and financial risk. Okay, I normally ask this question when I'm teaching CAPM, that if there are two investment, A and then B, investment A and then investment B. If investment A, there is no risk. Investment B, there is risk. And this gives you 10%, and this also gives you 10%. Where will you invest your money? Everybody will conclude that you would have to invest it in what? A, because there is no risk. Under what situation will you want to invest it in what? B. Assuming I said B is 18%, you might likely to move on to what? B, because you're going to make extra return of 8%. That 8% is what is called a risk premium. And just as we said, your cost of capital will reflect both your risk-free rate plus a risk premium. So this is the return you will get if there's no risk attached to that particular debt. So if there's a risk attached to that particular investment, you will want to get a risk premium of what? 8%. So that your cost of capital for this investment will be the 10 plus the 8%, which is equals to what? 18%. So CAPM is simply telling you that the cost of capital, let's see, CAPM is simply telling you your return on a risky investment should be giving us your risk-free rate plus the beta market return minus the risk-free rate. Okay, risk-free rate plus the beta market return minus the risk-free rate. I do appreciate at F9 level we're using CAPM to calculate only cost of equity. It is not used to calculate only cost of equity. It is used to calculate the return on a risky investment, for which equity is one of the risky investment. The determining factor is the beta that you are putting in here. So if I want my cost of equity is risk-free plus the equity beta, market return minus risk-free. If I want my cost of debt is the risk-free plus the debt beta, market return minus the risk-free. If I need a WACC, it's risk-free plus my weighted average beta into bracket market return minus the risk-free. So the input is the beta you are putting in. If you put in whatever beta, it should give you its corresponding what? Cost of capital or the return. So this is the basic. Risk-free is the return that we will get if there is no risk attached to that particular project or that particular investment. And our assumption here is that government securities are risk-free, so we can use government security rate. Okay, market return is the average return in the industry in which the project or investment is in. Of course, it is the examiner's responsibility to give us the risk-free. It's the examiner's responsibility to give us the market return. But one thing we need to refresh our mind on is the difference between market return and the risk-free is also called the equity risk premium. The equity risk premium, or somebody will say the market risk premium. The market risk premium. The market risk premium. Okay, so that is what you would have to think of. Okay, beta measures the systematic risk. As we all know, that risk, which is the total risk, is divided into systematic and then unsystematic. Is divided into systematic and unsystematic. Okay, so what is the systematic risk? Systematic risk is the risk that cannot be reduced or eliminated as a result of you having a diversified portfolio. But unsystematic risk can be reduced or eliminated as a result of you having a portfolio of investment. Okay, so systematic risk is also called market risk. It's also called market risk here. Also called market risk. Okay. Unsystematic risk is also called specific risk because it relates to that particular company or is unique to that particular company. Okay, systematic risk relates to the market, the industry in which the investment is in. And as we say, systematic risk cannot be reduced, but unsystematic risk can be reduced using portfolio of investment. And this is the clue. So the diagram to explain that is this. Okay, this is your total risk. This is your total risk level. And this bit is the unsystematic risk. And that bit is the systematic risk. And this is your level of investment. Okay, so the more investment, different investment that you have, the more you have diversified. And the more you are diversified, you will see that your unsystematic risk is what? Actually decreasing. Systematic risk become constant. At this point onwards, from this point onwards, what happens? You have only what? Systematic risk. What is the meaning? All the unsystematic risk is eliminated. And at that point, we say the investor has got a well-balanced portfolio. A well-balanced portfolio. Okay? CAPM is assuming that all the unsystematic risk is eliminated because the investor is rational. And as long as the investor is rational, we will be able to have only systematic risk. And those are the formulas in there for you. Those are the formulas in here for you. Okay? So that is the formula for CAPM. Now let's move on to a higher level. Let's move on to a higher level. Systematic business risk and systematic financial risk. Systematic business risk. We all said that a company that is all equity faces only business risk. A company that is debt equity faces both business and then financial risk. Okay? Faces both business and financial risk. So let's go back to that analysis before we will come back to the note. So let's refresh our minds on that. If a company is financed only by equity and a company is financed by debt and equity, okay, we all said if it is all equity, we call it ungeared. If it is debt equity, we call it geared. If it is all equity, the company has got only business risk. If it is debt equity, they've got business and then financial risk. Okay, now we are going to introduce B-test. B-test measure systematic risk. So if beta measures systematic risk, what sort of systematic risk is that? When a company is having all equity and is ungeared and is having only business risk, and I tell you this company's equity beta is BE. What have I told you? That BE is measuring the systematic risk attached to that particular company. And because that company is ungeared and is having only business risk, its equity will measure only systematic business risk. We don't normally bring systematic business risk. We say that beta is measuring what? Business risk, because automatically once it is beta, it is measuring systematic risk. So the equity beta of a company that is ungeared measures only business risk. Equity beta of a company that is geared measures both business and then what? Financial risk. Examiner might not necessarily be telling you all these figures. This equity beta is ungeared. This equity beta is geared. It's your job to know that. So if you look at the capital structure of the company in front of you and the company is having debt and equity and they've given its beta to you, automatically that beta is a geared beta, which is measuring both business and financial risk. If that company is all equity, then its beta measures only what? Business risk. Okay, now we have made mention of equity beta. Let me clear this. Equity beta could be geared or ungeared, depending on where you are picking from, as we've done. If I say equity beta and I'm picking from a debt equity company, then that is geared. If I am picking from only equity company, that is ungeared. I'm going to introduce another terminology, which is called asset beta. Okay, when a company's asset beta is given, asset beta measures only business risk, irrespective of whether the company is geared or ungeared. So this company here, which is geared, I can tell you this company's asset beta is equals to 1.5. What have I told you? What I have told you is that even though this company is geared, because I have mentioned asset beta, that 1.5 is measuring only business risk. That 1.5 is measuring only business risk. So watch out for these terminologies. Watch out for these terminologies. Asset beta measures only business risk, irrespective of whether the company is geared or not. But equity beta, you have to pause and ask the question, is this equity beta from a geared company or that equity beta from an ungeared company, before you'll be able to know whether it is geared or ungeared. But the moment I say asset beta, wherever you are picking from is measuring only what? Business risk is the base. Okay, so that is what they've told you in this analysis, separating systematic financial risk and systematic business risk. Okay, now let's come back to Miller and Modigliani again. So Miller and Modigliani included their principles in CAPM, and they just told us that in a situation where you are moving between geared and ungeared, I told you in the previous session that the moment you are moving between geared and ungeared, then Miller and Modigliani is flashing you, as long as you're dealing with market value, cost of capitals and all that. Okay, so Miller and Modigliani is telling you that if we are similar in all respect, it means we have the same business risk. If we are similar in all respect, it means we have this same business risk. So assuming these two companies, let's say this is company A and this is company B. Okay, A and B are similar in all respect, with the exception that B is geared and A is ungeared. The meaning is they all face the same business risk. As long as we are in the same industry, the assumption is we face the same business risk. So if we face the same business risk, when I give you the equity beta of B, which is measuring its financial and business risk, and I need the beta of A to do something, what should I do? Miller and Modigliani is telling you, you can pick the beta of B because the beta of B should be the same as the beta of A as a result of business risk only. Let me come back. If I need the beta of A and beta of B is given, that beta of B being geared is measuring both financial and business risk. However, because B and A are the same in terms of business risk, whatever business risk of B will be the same as the business risk of what? A. Therefore, by picking the business risk of B, I can use it as a proxy for calculating the beta of A. And this is what is called the geared and ungeared betas. Giving me a geared beta, I should be able to use it as a proxy to go and calculate the ungeared beta. Giving me an ungeared beta, I should be able to use it as a base to calculate that of what? A geared beta. And they gave that big formula. All what they said is that the asset beta, which measures only business risk, asset beta is the same as an ungeared beta, which measures business risk, should be calculated as the equity beta geared, market value of equity plus market value of debt, 1 minus T plus debt beta, market value of debt 1 minus T divided by equity plus debt 1 minus T. And this one should give you the full formula. So giving me the equity beta, which is geared, and debt beta, and equity and debt, I should be able to calculate the asset beta. Giving me the asset beta, giving me the debt beta, I should be able to calculate what? The equity beta geared. Miller and Modigliani assume debt is risk-free, as we said in the previous one. So if debt is risk-free, then beta, which measures risk of debt, is going to be what? 0. So if debt is assumed to be risk-free, then the beta of debt, which is measuring the systematic risk associated with that debt, is going to be what? 0. So the whole of this bit of the formula is going to be 0. And in fact, this is the bit that you are more likely to use in the P4 exams. This is the more likely you are supposed to use in the exams. So now let's quickly go to the lecture note. That's the formula I've given to you here. Let's go quickly to the lecture note. We take this example to illustrate. Gauss PLC is an all-equity company whose beta coefficient is 0.95. Stars PLC is a levered company and in all other respects has the same risk and operating characteristics as Gauss. The capital structure of Stars PLC is as follows. Nominal value, market value. The debenture of Stars PLC are virtually risk-free and the corporation tax rate is 40%. What will be the predicted beta of the equity of Stars PLC? Okay, now we have been given two companies, Gauss PLC and then Stars PLC. Gauss PLC is all equity finance. If these two companies are similar in all respect, it means they have to get the same business risk. Financial risk is as a result of your debt equity. So we might not have the same financial risk, but we might have the same what? Business risk. In the first place, because Gauss is all equity, Gauss automatically hasn't got any debt. So Gauss is ungeared. So the beta of Gauss of 0.9 is what? Asset beta. It's an ungeared beta. It's measuring only business risk. I need the beta for Stahl, which is geared because Stahl is having what? Debt in its capital structure. Okay, so if that is the case, Stahl is supposed to be geared and as such, its beta should measure both business risk and then what? Financial risk. So how will I be able to get the beta of Stahl? I will use Gauss as a base or proxy for calculating that. So giving me the BA, I should be able to calculate the BEG, which is the gear, using the Miller and Modigliani formula. Debt is assumed to be risk-free. So that bit of the formula is going to be what? 0. So this is what we are going to do. The straightforward thing here is that we will say the asset beta should be equal to the equity beta geared, market value of equity, market value of equity, market value of debt, 1 minus T. So here was given as 0.95. There is given as 0.95. 1 minute. 0.95 should be given as, this is what I'm looking for. We need the market values. See, the question gave you nominal values, which is the same as balance sheet values. You don't need them. You need the market value. Market value of equity and debt is 15 and then 6. So I'll say equity is 15. 15 plus 6 into bracket. Tax rate is 40%, so 0.6. And what will be the geared beta of that company? And that is 1.178. So that is that. Okay, geared beta should be greater than ungeared, because geared beta should include financial risk. So that is the science. The figures that you get should make what meaning to you. There should be some meaning. Okay, so that is the base for that. Now let's go to the application. The first application of this CAPM and Miller and Modigliani combined is we calculating project-specific cost of capital. When we did the investment appraisals, we said the discount factor we need as the cost of capital should reflect or should be appropriate, and it should be consistent with those cash flows. Therefore, it should be consistent with the risk of that particular project. It should be consistent with the business and the financial risk of that particular project. When we came to cost of capital, we said we can use our current WACC to appraise a new investment only when the business risk is similar or the same, or financial risk is the same. What if the business risk changes significantly, the financial risk changes significantly? It means we cannot use our current WACC. We will need a WACC specific to this particular new project that will reflect the business and financial risk of that particular project. And how do we do that? We have to think about calculating project-specific cost of capital through Miller and Modigliani and CAPM. The whole picture is this. For instance, as I said in the earlier sessions, if I'm in the mining industry and I'm going to do something in the education industry, I would need the business risk in the education industry. So first, I would have to go to the education industry and look for a beta. That beta is what is called the proxy beta. That's why I've given you the stages. Your first stage is look for a proxy beta. And that proxy beta ideally should be the industry average beta of the industry in which the new project is supposed to be undertaken. When you pick that proxy beta might be geared. If that proxy beta is geared, remember that proxy beta is measuring business and financial risk. We are not interested in the financial risk. Companies in that industry will face the same business risk but not the same financial risk. So we need only the business risk. So the financial risk element is supposed to be removed. The process of you removing that financial risk element is what is called you are ungearing it. Because the moment I ungear, ungeared beta, which is also called asset beta, measures only business risk. So take off the financial risk element and get the beta that measures only the business risk. And you come and ask yourself, so the second stage here is ungear the proxy beta to take off the financial risk. Your third stage is, if you do the ungearing in stage 2 and you get the one measuring only the business risk, that is the business risk you are going to adopt in that industry. You next have to ask yourself, how are we going to finance the project? Have we got debt? If our company has got debt, then we wouldn't face only that business risk, we will also face that financial risk. our financial risk. So if we have debt, our financial risk is supposed to be included in that beta. And the process of we bringing our financial risk back is what is called re-gear. So re-gear the asset beta to reflect your debt equity proportion, to reflect your financial risk. Your next stage is put it in the CAPM formula, and then you calculate cost of equity, and then you weight the cost of debt and cost of equity to get a WACC. So to calculate project-specific WACC, you need a proxy beta, you ungear it, you re-gear it, you put it in the CAPM, and then you put it in the WACC. So let's use figures to illustrate. So I'm going to use Hot Alert in this case to do that. Hot Alert PLC produces domestic electric heaters. The company is considering diversifying into the production of freezers. Data on 4 listed companies in the freezer industry and for Hot Alert are shown below. Freeze Up, Glow Cold, Shiver All, Top Peaks, Hot Alert. Fixed asset, working capital financed by bank loans, ordinary shares, reserves, turnover, earnings per share, dividend per share, price earnings ratio, beta equity. The par value per ordinary shares is 25p for Freeze Up and Shiver All, 50p for Top Piece, and £1 for Glow Cold and Hot Alert. Corporate debt may be assumed to be almost risk-free and is available to Hot Alert at 0.5% above the Treasury bill rate, which is currently 9% per year. Corporate taxes are payable at a rate of 35%. The market return is estimated to be 16% per year. Hot Alert does not expect its financial gearing to change significantly if the company diversifies into the production of freezers. Required, estimate what discount rate Hot Alert should use in the appraisal of its proposed diversification into freezer production. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important that this assumption is likely to be to Hot Alert estimate of the discount rate it should be A above. For this purpose, assume that Hot Alert and the 4 freezer companies all have a debt beta of 0.3. Discuss whether systematic risk is the only risk that Hot Alert shareholders should be concerned with. Okay. Right, so this is the question. I am asked to come out with a discount factor that the company should use to appraise the new project. How will I know? You would have to read the question to come out with certain things. My current WACC is not appropriate when I am moving to a new industry. In that case, business risk is going to change. So this question told us that this company is considering diversifying into production of freezers. So the moment we are diversifying into another area of business, business risk is changing. And the moment business risk or financial risk or both changing, then our WACC should also change. And we will need the project-specific WACC. So we need a cost of capital or a WACC that is specific to the business and financial risk associated with the production of freezers. So what should we do? We would have to go to the freezer industry and go and look for a beta. Ideally, that beta should be the industry average. If you go there and only one company is given, pick that company's beta. Like this one, they've given us these 4 companies in that freezer industry. So what we have to do is we need to get the proxy beta. What betas are given? If you come here, they've given us equity beta or beta equity. They normally call it equity beta. And these are the equity betas of those 4 companies. All what you need to remember is this is Hot Alert. This is your company now. You don't need it. That one is in the electronic industry. So therefore, if these are the betas, we have to pick them as the proxy beta. If we pick the proxy beta, our question is, these betas, are they geared or ungeared? We are picking the betas from these 4 companies. These companies, are they having debt? Yes, they are having debt because they have bank loans. So if they have got bank loans, then these betas are geared betas measuring both what? Business and financial risk. So I'm taking you through straight. So when we come down here, We're going to say pick the proxy beta. So this is your proxy beta. We pick that of all the 4 companies, and then we want the average. So we are dividing it by 4, and this is the average beta. But because they are geared, this becomes the average geared beta. Okay, we want the average. So I've got the average geared beta, which is measuring both business risk and then what? Financial risk, which is measuring both business risk and then financial risk. So if it's measuring both business and financial risk, there is the need for us to what? Take off that financial risk. If we take that financial risk, we will get only the business risk. That process is what we said it is called ungearing. And to ungear, we need that Miller and Modigliani formula. The asset beta is equal to the equity beta geared, equity over equity plus debt, 1 minus T. Okay, so we have to get the market value of equity of all the industry companies in there and the market value of the debt. So what will be the market value of the debt? If you go to the question, you will see that all the 4 companies were having bank loans, and their bank loans were 5.3, 12.6, 18.2, and then the 4, which is giving you a total of 40.1. So I have got the value for the debt. I will also need the value of equity. Okay, I will also need the value of equity, and the value of equity, this is how we calculated that. I have to show you that. Okay, we all know the market value of equity should be the number of shares multiplied by market price. So what should we do? Let me take you up here and I'll bring your mind on this. What should we do? Now, number of shares. If you look at the question, they gave us ordinary shares in terms of thousands of pounds, and you see this asterisk. And we all know number of shares is the nominal value of the shares total divided by nominal value per share. So if you pick freeze up, for instance, freeze up, its nominal value of shares is 4,000. But this asterisk is telling us that freeze up nominal value. They said the par value per ordinary share is 25p for freeze up and shiver all. Therefore, freeze up nominal value is 25p. So the number of shares for freeze up should be the 4,000 divided by 25p. And that is why they got the 16,000 there for you. That is why they got the 16,000. Okay, that's where they got a 16,000 here for you. You do the same thing. You pick the total share value, you divide by number of the nominal value, and you will get a number of shares. Next, I will need the market price. What will be the market price? Okay, so this is basically the number of shares. Now, if we go to the question, what is the market price? Okay, what is the market price? The market price wasn't given to us, but we all know from basic financial management that one way we can calculate market price is by you multiplying your PE ratio and the earnings per share. So this is where the examiner is expecting you to be a bit broader in your understanding of financial management. Market price wasn't given, but they've given me PE ratio, they've given me earnings per share. So giving me PE ratio, giving me the earnings per share. When I multiply the earnings per share and the PE ratio, it should give me the market price. If you can do for freeze up, you should be able to do for all of that, all of them. That is the reason why I'm doing one. So the earnings per share is 25 cents or pence, and then the PE ratio is 12. So you see that to get that market price, we multiply the PE ratio and the earnings per share. The earnings per share was the 25, and then the PE ratio was 12. So for all the other companies, we pick their earnings per share and PE ratios, and then we multiply by number of shares, and we got their market values. So in the industry, the total market value of equity is simply 192, and then the total market value of debt is simply 40.1. So having got the 40.1 and then the 192, I can put it in the Miller and Modigliani formula. Okay, that is why we said D gear. D gear is the same as you and gearing it. Okay, so my BA is equals the BE, that is the formula. The BEG, the average geared beta in the industry, is the 1.175. So we put the 1.175. Market value of equity is 192. Okay, 192. We just doing the substitution to the formula. Debt value is 40.1, and then deduct the tax rate out of the 1, and then you will solve this mathematically, and this should give you your asset beta. So this is measuring only the business risk. We have taken the financial risk out of that, so we've got 1.035. The next question is, as long as hot alert goes to the freezer industry, they're going to face this business risk. Will it be the risk that they will face only? No. We need to ask the question, hot alert, will you have debt? If you hot alert, which is your main company, has got debt, then they will face this business risk, and they will also face the financial risk associated to your company, not to the industry or that proxy company, to yourself. So we pick the proxy company in order to get the business risk because we face similar business risk. The moment we get the business risk, we do not have to do anything with that company again. We come to our company. Have we got debt? If we have got debt, then there should be financial risk. So hot alert, have you got debt? Yes, hot alert has got debt. Bank loan of 17.4 million. And hot alert has got equity. So as long as they've got debt, there is a financial risk. There will be the need for us to what? Re-gear to bring that financial risk that we will face. So we need the debt equity. Is the same formula. We need the debt equity. What is its debt? Its debt is the bank loan of 17.4 million. And what will be the market value of equity? Market price wasn't given. Number of shares wasn't given directly. So the same as we did for freeze up, the same thing here. What will be the number of shares? Divide the market, the value, the nominal value total of the hot alert by the nominal value per share to get the number of shares, and then multiply the earnings per share by its PE ratio to get the market price. Okay, and this will give you the market value. Put it in the formula and then re-gear. And when you re-gear, you should be able to get that market, the equity beta geared. This is a change of subject that they've done for you. I don't normally recommend this because this formula is not on the formula sheet. What I normally do is the same formula. This is what is there. Equity beta geared, equity over equity plus debt 1 minus T. It's issue of change of subject. So all what I will do here is that BA is equals to this. Equity over equity plus debt 1 minus T. Now I've got my asset beta, which is measuring only the business risk, and that figure is 1.035, which is equal to, this is the geared one I'm looking for. Now the equity figure is 33.92 plus the debt figure, which is 17.4 into bracket 0.65, and you look for this figure. What do? I use my calculator. I will say 0.65 multiplied by 17.4 equals to, I've got that. I add it to 33.92 equals to, this is over 1. So the answer that I've got on my calculator, I multiply it by this 1.035 equals to, then I will divide it by that. So I do 1, 2, 3, 4, and then I will get this figure. It's mathematical thing. I don't have to teach you the arithmetic. Okay, so if you solve it mathematically, you should be able to get the geared beta. So the geared beta is this. So this one will measure the business risk and financial risk associated with this project. And then you put it in the CAPM formula. You put it in the CAPM formula, which everybody knows how to calculate that. You put it in the CAPM formula, and it will give you your cost of equity. Having got that cost of equity, there will be the need for me to calculate the WACC because we've got debt. As long as we've got debt, our cost of capital should be both equity and debt weighted. So I bring my cost of equity in the WACC formula, and then market value of our equity, which is hot a lot. We haven't got anything to do with the other companies. Now it's our business. The only thing we need from the other companies is their business risk we are also going to face. That's it. Okay, our market value is this, and the cost of debt, the question said, is 0.5 above the risk-free rate, so that is 9.5%. Don't forget to knock off 1 minus T, and then value of debt, and then you sum up the two, and then that should give you the overall WACC. That should give you the overall WACC. So this is how we calculate the project-specific cost of capital. You look for the proxy beta from the industry. Here, we went to the freezer industry, got the average beta. That average beta was geared, so there was the need for us to ungear it to get the business risk in that freezer industry. The moment we go to that freezer industry, we will face that business risk. So when we get the business risk in the freezer industry, we ask ourselves, are we going to have debt? We have got debt, so we will also face financial risk, re-gear it to get the beta that measures both the business and financial risk. Then when you get that, put it in the CAPM formula, and then whatever cost of equity you get, put it in the WACC combined with cost of debt, and you have the overall cost of capital. And this is what we will need as the discount factor for appraising that particular investment. So watch out. It's not every investment appraiser question the examiner will give you the discount factor. He will push you to do this calculation, and he will also push you to calculate the cash flows. So having got your cash flows, having got this discount factor, you discount them and you calculate your MPV accordingly. So watch out for some of these issues. Watch out for some of these issues. The second bit of the question is telling us, we're just bringing your mind on something. The second bit of the question is just telling us that how can Miller and Modigliani assume that debt is risk-free? So in the calculations that we did, when we're gearing and re-gearing or ungearing and re-gearing, in the formula, we assume debt beta is going to be 0. So if debt beta is going to be 0, then we are capable of using this formula. We didn't use anything beyond that because we are assuming here that debt beta is equals to 0. The criticism here is that Miller and Modigliani, you cannot assume that because debt is not risk-free. So its beta is not going to be 0. So we're trying to bring your mind on. Okay, in case you go to the room, it's very remote. I haven't yet seen it in P4 anyway. In case you go to the room, exam room I mean, and then the examiner gives you a debt beta, then you cannot forget about the other side of the equation. You will need the whole of the equation, which is the asset beta equals to the equity beta, equity over equity plus debt, 1 minus T, plus the debt beta, debt 1 minus T divided by equity plus debt 1 minus T. So this is what we have to do. But all along, we have been assuming that debt is risk-free and debt beta is equals to 0. So in requirement B, they've given us debt beta of 0.3. So it means we have to redo all the calculations again. The stages are the same. The only difference we're going to see here is that we are not just going to do only this bit of the equation. We would have to include the debt beta in the whole calculation. It's just issue of the mathematics. Okay, but principle-wise is the same. So debt obviously cannot be assumed to be risk-free. Okay, debt cannot be assumed to be risk-free. So how will we do the ungeared? So we pick the proxy beta, we calculated the average proxy beta, if you can remember, and we said it's 1.175. Okay, market value of equity was 192, 40.1 for debt. Don't forget to knock off the tax. That is what we did on the assumption that debt beta is risk-free, and as such, beta is equals to 0. Okay, now they've given us debt beta of 0.3, so we have to bring the other side of the equation, debt and tax effect, equity and debt and tax effect. So when we solve this mathematically, it should be able to give us the asset beta. Okay, it's going to be slightly different because of the second bit of the equation. We would have to re-gear because our company has got what? Debt. So this is measuring only business risk. So if we have debt, as hot a lot having debt, we need to re-gear. And that is the same formula. So you see this one come here, 1.07 as the asset beta. Then the equity beta is what we are looking for. Hot a lot equity is this, its equity and its debt and the tax effect, plus the 0.3. Don't forget about that bit. And then 17.4, our debt equity proportion is what we are bringing. When we re-gear, it should give us what? 1.327. And then you put it in the CAPM, and then you put it in the WACC. So all what this bit is trying to bring your mind on is that in case they give you a debt beta, don't forget about the other side. But as I said, a P4 is almost assumed that debt is risk-free. So if you go to the examination room, examiner don't give you the debt beta, just tell him you are assuming that debt beta is equals to 0, and you forget about this bit of the equations. Okay, and you apply what we've done there already. The next question is there only systematic risk? Okay, investors should not be concerned with only systematic risk because we all said there are two risks. Total risk is made up of systematic and unsystematic. Unsystematic can be reduced or eliminated as a result of diversification. Systematic cannot. Okay, and CAPM is assuming that the investor is having a well-balanced portfolio, so all the unsystematic risk is eliminated. How many different levels of investment should we have for us to be practically convinced that all the unsystematic risk is eliminated? I can't give you that answer. It's a theoretical thing. It's an assumption. So that is one of the criticisms of CAPM. CAPM is assuming only systematic risk on the assumption that all the unsystematic risk is what? Eliminated. How many different investments should I have to get? Is it 10? Is it 30? Is it 50? It is really difficult in practice to know exactly what combination of different investment that will eliminate all the unsystematic risk. So investors should not only be concerned about the systematic risk, they should also be slightly concerned about what? The unsystematic risk. Okay, so that is the challenge. So the time is up, and I thank you very much for your time, and I'll see you in the next session. And in the next session, we're going to look at WACC of combined activities, and then we look at adjusted present values as well. Thank you very much.